So, National Bank of Canada just made a $5 billion gamble. It's a massive move, and it's all about fixing a fundamental weakness that's been part of the bank's story for decades. Today, we're going to dig into what this huge bet is, why they made it, and most importantly, what it means for investors.
And that brings us to the core question, right? National Bank is consistently Canada's most profitable bank. But does that automatically make it a great stock to own? Well, not so fast. To really answer that, we need to look under the hood.
Because to truly get the investment case here, you have to see the flaw that's been hiding inside its very successful formula. It's this hidden weakness that has defined the bank for years, and it's the whole reason for this $5 billion bet we're talking about.
Okay, so first things first, let's appreciate just how unique National Bank is in the Canadian market. It's a genuine paradox. It's a small player that consistently punches way above its weight class when it comes to making money.
As you probably know, Canadian banking is dominated by the Big Six. But as you can see here, National Bank is, by a pretty wide margin, the smallest of the group. It holds only about 6% of the total assets. They're the clear underdog.
But here's where it gets really interesting. Despite being the smallest, it is the most profitable. This number, 16.7%, that's its return on equity, or ROE. It's a key report card for how efficiently a bank generates profit. And National's ROE consistently beats its much larger competitors, which, if you're an investor, should make you ask one simple question: how are they doing it?
And that question, well, it leads us straight to the flaw in their winning formula. You see, the very things that have made National Bank so profitable have also created two significant concentration risks that have worried investors for years.
The first problem is all about geography. Historically, National Bank is the Bank of Quebec. Just look at this. Nearly half of its revenue comes from that one province. Now, while that regional dominance has been a huge strength, it's also a major vulnerability. It ties the bank's fate to a single provincial economy.
The second risk is about how it makes its money. Think of the bank as having two engines. You've got your personal and commercial banking. That's like a reliable salary. It's steady, it's predictable. But its financial markets division, that's the real powerhouse. Think of it as a volatile but massive performance bonus. In a recent record quarter, this one division drove over half the bank's profit. That's powerful, sure, but it means their earnings are less predictable and considered lower quality by the market.
So to solve both of these concentration problems in one single move, National Bank made its biggest bet ever, a $5 billion all-share deal to buy Canadian Western Bank.
And the strategic logic here is threefold. It's pretty brilliant, actually. First, it instantly solves the geography problem by giving them a major footprint in Western Canada. Second, it bulks up that reliable salary part of the business, increasing their stable commercial loan book by over 50%. And third, it opens up a huge opportunity to sell their more advanced products to CWB's existing clients.
Okay, for any investor looking at this is the number you need to remember: $270 million. That's the target for annual synergies that management is promising to squeeze out of this deal. Hitting this target is absolutely critical for the acquisition to create shareholder value and prove that the high price was worth it.
So this massive, transformative deal creates powerful arguments on both sides, and it presents a really clear dilemma for investors. Do you bet on this incredible transformation, or do you worry about the very real risks?
All right, here's the debate in a nutshell. The bulls believe that if National Bank pulls this off, it emerges as a stronger, more balanced bank that deserves a higher stock valuation. The bears, on the other hand, they see massive execution risk. They worry that merging complex systems and, more importantly, two very different corporate cultures could cause them to lose key staff and clients, ultimately destroying value.
Now, the bull case got a major boost right out of the gate. Reports are suggesting the integration is progressing well and ahead of schedule. In fact, in the very first quarter after the deal closed, the bank had already achieved an annualized synergy run rate of $115 million. That's 43% of their three-year target, hit in just a few months.
But the bears point to a risk that doesn't show up in the financials, at least not at first. Canadian Western Bank built its success on a people-first, relationship-driven culture. National Bank's center of gravity has always been its fast-paced, transaction-focused financial markets division. The crucial question is, can you really merge these two opposite cultures without breaking what made CWB special in the first place?
Okay, so with these strong competing arguments, what should an investor actually be looking at to track whether this massive gamble is paying off? What are the vital signs?
First, you have to understand this valuation puzzle. National Bank's stock is both expensive and cheap at the same time. The market gives it a premium price-to-book multiple because its high ROE is so impressive. But it gets a discount price-to-earnings multiple because the market doesn't trust the quality of those volatile financial markets earnings. The entire bull thesis here is that this deal will finally fix that PE discount.
So here's your scorecard for tracking this deal. Keep your eyes on synergy realization. Are they hitting that $270 million target? Watch credit performance. How is that newly acquired loan book actually performing? Check their capital ratios. Is the bank staying financially strong? And most importantly, look at the revenue mix. Is that stable banking income growing as a share of the total? That's the ultimate sign of success.
Ultimately, it all comes down to this. National Bank has pushed all its chips in, betting that it can transform itself from a regional champion into a national heavyweight. The early signs are promising, for sure, but the hardest work is still ahead. The real question for investors isn't just if they can do it, but at what cost and whether the market has already priced in a perfect success story.